Okay, let's go ahead and get started. Hopefully everybody can hear me. If you have any technical issues, just type into the chat box or the Q&A box, and we'll try to get it squared away, or at least Tracy will. So today we're going to talk about the micro E-mini stock index futures. You've probably heard about them when they came out early May, so they've been out about a month, but people are talking about it all over the place because it's an exciting product. In our view, it is a game changer in a lot of ways, and so we're going to talk about that today. If you're wondering what they are, we'll talk about that also, but basically it's, in a nutshell, it's a micro-sized E-mini SMP futures. There's also a NASDAQ, Russell, Dow, and the idea is the leverage is still the same, so you're still getting the leverage of the futures markets and all the benefits of the futures markets, but you are playing with a lot less risk when it comes to P&L, your profit and loss swings, that sort of thing. So let's go ahead and get started. If you don't know who I am, my name is Carly Gardner. I am a commodity broker. We handle futures and options trading. At DeCarly Trading, we're located in Las Vegas, Nevada. Yes, people live in Las Vegas. No, it's not just a bunch of casinos in the desert. If you have any questions about anything that we talk about today, there's my contact information. I'd love to hear from you. I try to answer emails around the clock. I do sleep sometimes. They're on our web address at decarlytrading.com. We have 30 to 40 trading videos. If you're interested in learning, they're all free. There's a bunch of articles there as well. And if you're on social media, check us out. If you just search for Carly Garner or DeCarly Trading on any of the major social media sites, you should find us. And we'd love to see you there. We do post some commentary on markets and charts and that sort of thing. Also post a lot of pet photos. So if you absolutely hate pets, maybe it's not the right place for you. But if you don't mind pets and you want to talk about commodity trading, it's a good place to see what's going on. I am a broker, a strategist, and an author. I write a monthly column for Stocks and Commodities magazine. I also contribute content to Jim Cramer's Mad Money. He uses our technical analysis on the show about once a month on average. Our latest was about a week or two ago, about a week ago, I guess, last week, talking about the treasury markets and the stock market. So we were looking for those two markets to flip, and time has yet to tell whether that's going to be the case or not, but I still believe that that's true. Stocks have turned the corner as we expected. Bonds, for whatever reason, are being a little stubborn, but I do think they probably are rolling over and will eventually move lower, but we'll see how it goes. Our brokerage clients receive newsletters that we write in-house, the DeCarly Perspective and the Financial Futures Report. We offer commentary, opinions, market research, as well as trading ideas and that sort of thing. Obviously, we don't have a crystal ball, so we can't tell the future, but and sometimes we're wrong, sometimes we're really wrong, but sometimes we're right too. So it's part of the game. But we'll give you some ideas. Our clients obviously don't have to take the trades that we recommend, but it gives them some guidance, and if they like what they see, obviously they can participate. If you're tech savvy, you may want to consider downloading our mobile app. The mobile app is free to download, and the free version actually has quite a bit of great information, news feeds, both text and video. There's actually flash quotes in there, charts, that sort of thing, but it's just a lot of good, solid information. And if you do happen to be a client, you can log in and get access to restricted content, which is trading recommendations and charts and ideas and that sort of thing. Okay, one last shameless plug. If you're interested in learning more about trading futures and options, or anything about, well, I was going to say anything that we talk about today, but the reality is we're going to talk about a product today that didn't exist when I wrote these books, so scratch that. But the principles are the same, even though the products are different. So anyway, it's, higher probability commodity trading and a trader's first book on commodities can be found at any major book outlet. They're cheapest on Amazon, obviously, and they are available in electronic versions, which is even cheaper. Oh, and by the way, we have a buy one, get one free deal going on today. So if you didn't receive an email with that letting you know where to go to take advantage of that opportunity, if you want to, email us and we'll send you a link. If you buy higher probability commodity trading, you get an autographed copy of it. We'll throw in the other book for free. Okay, let's get started. So there's a substantial risk of loss in trading futures and options. Hopefully all of us in attendance today understand this. Trading is not suitable for everybody, even if we're talking about trading micros, which are small and you probably, can't get into too much trouble. Still risky. You can still lose money. First, let's talk about why trade futures. I think some of our audience today, I believe, are people that possibly aren't trading futures today or are stock traders that might be interested in getting involved in futures, or at least dipping a toe in the water, and that's exactly what the micro SMP futures are for. It's to bring people into futures that previously thought that futures were too risky for them. This is because it's such a small contract, or I should say, not just the E-mini S&P, by the way. We're talking about several stock index contracts. So because these contracts are small and you're not going to make or lose a ton of money per point in price movement, it kind of opens the door for futures trading to people that previously didn't think that they had the risk capital or had the guts to do it. So we're going to talk real quickly about why futures are favorable over stocks in some regards, not all regards, and again, we'll talk about that. But traders tend to flock towards what is familiar, and that's stocks and ETFs. They already have a stock account open. They've heard horror stories about futures. They don't know how to get involved. So it's convenient to just trade commodities, whether it's gold or crude oil or natural gas, or maybe even a stock index like the SPY or SPX. It's just easier to do it in their stock account. So that's what people do. But just because it's convenient doesn't necessarily mean it's the best way to go about it. In fact, futures is particularly on the commodities. So futures on gold or crude oil or natural gas are far more efficient trading vehicles. And you have around-the-clock access than any ETF out there. Most ETFs, when you're talking about commodities, actually take your money, or the investor, anyone that buys an ETF, that money goes into a pool. That pool is then used to buy futures contracts. So you can see how, just on the surface, how it would be inefficient. You're talking about administrative costs, you're talking about slippage, you're talking about all kinds of rebalancing issues and costs and contango. So if you're going to trade commodities, you're better off doing it in the futures market if you have the risk capital, the wherewithal, and the risk tolerance. The great thing about futures trading is there's around-the-clock market access. Most futures and options markets are open 23 hours a day. And some people ask, are they liquid 23 hours a day? And the reality is, yes, they are. They used to not be. When electronic first started trading overnight, it was a little thin. But as the years have gone by, it's gotten to where there's definitely more liquidity in the day session. I'm not going to say that, but most of the markets are plenty liquid at night, even the options, and especially if you're talking about the stock indices like the E-mini S&P, the options are very tradable 23 hours a day. A futures trader, unlike a stock trader, has access to free leverage and a margin account. If you go to your stockbroker and you tell them you want to sell stock short, or you want to trade on margin, meaning you want to borrow shares that you don't necessarily have the money to purchase and invest on leverage, your broker will tell you he'll probably tell you need $100,000 in your account. He's probably going to charge you interest to do it. But a futures trader doesn't have to jump through those hoops. A futures trader has access to free leverage. There's no interest charges and a margin count regardless of how big or small the account is. At some brokers, you can open an account with as little as $2,000. The minimum in our brokerage is $2,000. So you can get started with a very small amount of money, have access to leverage, and have access to a margin account without paying any interest. And so we already talked about the efficiency of futures versus ETFs, but this is absolutely true, especially if you're talking about ETFs and obscure products, but that's really not our focus today, so I'll just keep my mouth shut on that topic. Another thing is you can buy or sell in any order. In futures, you don't have to own anything because you're not trading an asset, you're trading a liability. So if you think a market's going lower, you simply sell it and buy it back later and vice versa. There's no uptick rules, there's no share restrictions, there's no delays in acquiring shares. You don't have to ask your broker if you can borrow shares so that you can short them. If you want to sell a commodity or a stock index futures, you click a button, you're short. So some other advantages of trading futures: low account minimums. We kind of talked about this. You can trade futures and options on leverage with a couple $1,000 bucks. I'm not by the way, I'm not necessarily saying you should. It's really hard to make money trading in any market. Any type of speculating, whether it's stocks or futures or forex or whatever you're trading, it's really hard to do. And especially if you're trading in a small account, because if you're trading in a small account, you're limited on which products you can trade, which strategies you can participate in, and you're limited on the amount of room for error you're giving yourself. So it's not always necessarily a great idea to trade in a small account. I'm just saying you can, so you're not being told by somebody else how much you have to risk participate. Again, there's no interest or borrowing fees. It's a level playing field. Orders are generally filled on a first come, first served basis. Whether you're trading a 1 lot or a 500 lot, it doesn't matter. The exchanges treat everybody the same in regards to trade matching. The kicker with futures is you get favorable tax treatment if you're making money. Now, keep in mind there's no benefit to having favorable tax treatment if you're not making money. But if you are making money, you'll save yourself a little money on taxes trading futures relative to trading something like the SPY or the SPX, because you're taxed at a lower rate, and you're taxed at a 60-40 blend between long-term and short-term capital gains. Whereas if you were trading stocks or, SPY, SPX, whatever it is, you know what, I take it back. I think the SPX does qualify as the same tax treatment. But if you're trading most commodity ETFs and most stock index ETFs, you are subject to the traditional long-term capital gains or short-term capital gains, whichever category it falls into. But the nice thing about trading futures and taxes is you don't have to report each individual transaction to the IRS. You only report one number. At the end of the year, your broker gives you a 1099. You either made money or you lost money, and that's it. That's the only number you have to give the IRS. You don't have to tell them what you bought or sold, when you did it, so on and so forth. And another benefit of trading commodities and futures is it's exciting. Anything is possible in commodities. Now today we're going to talk about the micro E-minis. So with the micro E-minis, you're probably not going to change your lifestyle on any one particular trade. But that's really why everybody's interested or scared of trading commodities, the fact that you can make or lose a ton of money. I once saw a trader turn $10,000 into $500,000 in about 2 weeks. And unfortunately, the story didn't end well. He ended up losing it all within another 2 or 3 weeks after that. So that's just how much leverage is built into the markets. Obviously, you don't have to trade in that manner. This guy was obviously taking an enormous amount of risk throughout the entire process to see those kinds of swings. But those things can happen. And by the way, it happened during a time that we may never see again. It was during the financial crisis and the SMP crash, and he happened to be long a bunch of puts. So that's that. But anyways. Okay, so what are micro E-minis? A micro E-mini stock index future was created by the CME, the Chicago Mercantile Exchange, to overcome the largest obstacle keeping retail traders from futures trading, and that's risk. As a futures and options broker, when somebody asks me what I do for a living and I tell them, they assume, they get scared and nervous and uncomfortable because they hear all of these bad stories about trading futures and how people have lost money trading futures. The reality is futures trading probably isn't any more risky than trading stocks or baseball cards or anything else, but the difference is there's a lot of leverage, and most people do not have the mental or emotional capability of handling that leverage, or they get too fearful or too greedy. I mean, there's all kinds of things that come in line, but what I'm saying is it's not necessarily the markets that are risky, it's the traders participating in the markets that are not managing their risk properly. And I'm not saying that it's easy to do, because it's not, but it really is that simple. That said, that's where the micro E-minis come in. They are a smaller contract. They're 1/10 the size of the regular E-mini S&P. So it brings an entirely new world to the average retail trader, because you have the same leverage but less risk in terms of dollars, and you have more room for error. And I'll show you what we mean in a couple of examples later. But the basic premise is with a very small amount of money and a very small amount of risk, you can participate in the futures markets and get all of the benefits that used to be reserved for the bigger traders. So we just talked about it, the tax benefits, the overnight trading benefits, the ability to buy or sell in any order. All those sorts of things can now be accessed by even a small retail trader that isn't necessarily willing to take on much risk. So there are micro E-mini stock index futures for 4 products: the SMP 500, the NASDAQ 100, the Dow Jones, and the Russell 2000. With the micros, there are only futures, there's no options, but they can be used to hedge option risk. Or some of you might be trading stock options in the SPY or SPX, whatever it is, and you could actually use the micro minis to hedge that option risk. For example, if you have a position on and something happens overnight in your stock account and those markets aren't open for you to react to, you could counteract that with some micros in your futures trading account. Okay, so let's kind of talk about what size these contracts are and what that means to you as a trader. So the point value and therefore the notional value of these contracts is 1/10 the size of the traditional E-mini contracts. So in the S&P 500, it's $5 a point. Whereas if you've traded the traditional E-mini, you know that each point is worth $50. In the micro, it's only worth $5. So on an average day, I mean today is not an average day, and we haven't seen an average day for the last couple of weeks. But on an average day, the S&P futures probably move 5 to 10 points. So on a micro, on a 10-point day, you're only making or losing $50. So you can see what I'm saying about there's not a lot of dollar risk, even though you're getting all the leverage. And the reason you're getting leverage is the margin on this contract is only about $660 right now. The margin can fluctuate a little bit, but it's generally most likely going to be anywhere between $500 and $700 most of the time. With that in mind, we know that each point's worth we know that each point on the micro is worth $5 a point, so we can calculate what the notional value of the contract is. And what that means is, what is the actual value of the contract that we're trading? In other words, if you took 5 points and assuming the S&P was trading at 2,800 and multiplied that, you'd get 14,000. So when you buy or sell a micro futures, you're basically buying or selling about $14,000 worth of S&P 500 allocated stocks. This is much more reasonable than if you're trading a full-size contract, you're trading $140,000 worth of stocks. Some of you probably have been trading the E-mini S&P and you probably never thought or sat down and thought about just exactly how much money you were trading per contract. I know traders that'll trade 10, 20, 30 lots. Maybe even 50 lots or more. If you can imagine, each contract is worth 140,000 and you're trading 10 lots. That is a lot of money, and you can see how much leverage and how much risk is built into a position like that. A micro trader with $14,000 in stocks on the line, it's a little more manageable. If the world comes to an end and the S&P goes to zero, you lost 14,000. That's probably not going to happen, but if it did, that would be your total loss. So again, you're giving yourself more room for error, probably putting yourself in a situation where mentally you're in a better place to make good decisions because you're not swinging so much size and you're not seeing your account jump around in big dollar terms. The NASDAQ 100 is $2 a point. Notional value if the NASDAQ's at 7,500 is about 15,000. The Dow Jones is only 50 cents a point, which sounds like on the surface you might think, well, wow, that's a waste of time. But you know what? It adds up. If the Dow's up or down 200 points, you made or lost $100. So obviously these products probably aren't something you want to day trade with, or at least if you are going to day trade, use them as a practice vehicle, that's a great idea because it's one step beyond paper trading. Paper trading doesn't do a lot of good in my opinion because there's no emotions on the line. There's no risk of losing money. So it's like playing a video game. It's a completely different scenario than playing with live money. So if you're going to practice your day trading techniques, you might want to start in a paper trading account and then move into trading the micros so that at least you have a little skin in the game and you get a little feel for how it might be if you have good money on the line. But these products are probably more reasonable for position traders rather than day traders. And if anyone's trading the Russell 2000, which is a small cap index, it's $5 a point with a notional value of about $77.50. The Russell, if you've ever traded the Russell, you know, don't let the small notional value fool you into complacency. The Russell can really, really move because it's small caps. It moves quicker than some of the other indices. In fact, it's probably the most volatile of all of them. Okay, somebody's asking, how are the micros correlated to the minis and what prevents those two contracts from seeing big price differences? And we run into this a lot with, if you notice there are mini corn, mini wheat futures, mini soybeans. There are mini currencies, there's microcurrencies. So in some of the other complexes, we have the exact same scenario where there's a full-size contract and mini contracts. And those contracts really almost always, aside from maybe a couple ticks here and there, they'll slip and have slightly different prices, but for the most part, they are constantly in line with each other, because if they weren't, what would happen is arbitrageurs would come in and buy the one that's undervalued and sell the one that's overvalued and kind of play it like that. In the case of the stock indices, they are fungible, and that means if you were long 10 micros and short one mini SMP, you could ask your broker to offset those and you'd be flat. So because they're exactly fungible and because they're equivalent to the same thing, if you're trading the same notional value, they will always stay in line with each other in the long run. In the short run, you're correct, there can be some small deviances, but it's going to be temporary, a couple seconds probably at the most. There are excellent market makers, so even on the first day of trading in these products, there was actually a surprising amount of volume and liquidity on day one. But with that said, even if there weren't that kind of volume, the CME had market makers in place ready to make sure that the prices stayed in line. So here's just some quick stats. I mean, I'm not going to ask you to memorize this, and I'm not going to quiz you on it, but just to give you an idea, the symbols are really easy to learn. So the product codes or the symbols are just going to be an M for micro in front of the traditional symbol. So for the Emini SMP, it's MES. For the NASDAQ, it's MNQ. For the Russell, it is a little bit different. It's M2K, but I think that's probably the easiest to remember. And then the YM or the Dow is MYM. Just like the full-size contracts or the minis, or the original size mini, I should say, these are quarterly cycles, so they expire in June, September, December, March. These are cash settled, similar to the E-minis, so there's no difference there. I would always warn you, regardless of whether you're trading the E-minis or the micro E-minis, never allow this contract to go to cash settlement. Don't do it. The cash settlement process is this arbitrary equation that they calculate on the last trading day, and it takes account, like the futures market stops trading in the morning, and then the cash market continues to trade throughout the day. And so what they do is they take this crazy calculation based on the opening price of the New York Stock Exchange and so on and so forth, and they come up with a number for a settlement price, and sometimes that settlement price is dramatically different than what we would expect it to be. So just because the S&P trades its last contract in the morning of expiration at 28.50, we'll say, doesn't mean that's where they're going to settle it. It might settle at 28.60. It might settle at 28.40. So anybody that held contracts into expiration just waiting for cash settlement are probably going to be upset. And ironically, I've never seen anyone that holds to expiration, I've never seen the settlement work out in their favor. It's always against them, and they're always upset. And I can't blame them, but that's why we warn people to never do that. It's hard enough to make money. You don't need to leave it up to chance. Just if you're in the market and it's expiring, get out. Get into the next contract. By the way, the trading hours are exactly the same. So it's a little bit confusing with Globex. Basically, they open up trading at 5 p.m. Central on Sunday night, and then they trade through 4 p.m. Friday. So if they open up on Sunday, they trade basically if you exclude the pause every afternoon, they trade until 4 o'clock on Friday. But here's the tricky part. The futures market pauses for 15 minutes at 3:15 Central, and then it reopens at 3:30, and then it trades until 4, then it closes, and it's closed from 4 to 5, and then it reopens. Don't ask me why. It's the only futures market that has a pause like that. Couldn't tell you, but it is how it is. Now, some of you may not even realize that there is a pause. Some of you might think that the market closes at 3:15, and I run into that a lot. And that's because if you're trading with some of the discount brokers, they don't even let you know that trading beyond 3:15 exists. They just tell you it's closed at 3:15, and they don't even accept orders in that little window between 3:30 and 4. I can't really say I blame them too much because nothing good really happens in that window. We have clients that try to wait to the very last minute of the day to get out of trades, and it generally seems to work against people trying to do that, but we do allow them. Everybody's adults. We allow them to make their own decisions. Okay, so somebody's asking if the Russell is on the ICE exchange, and that's a really good question. No, these are all CME products. The CME actually bought the Russell back from the ICE, If you've been trading commodities for a long time, you know the Russell started at the CME, then it moved over to the ICE, and now it is actually back to the CME. And so is the micro. So both the mini and micro Russell are on the CME. This chart, I actually posted this to Twitter, and somebody told me that anybody could draw a V on a chart and wondered, what I was trying to prove with this. Well, the only thing I'm trying to prove with this is this particular move, the sell-off from September to December, and then the rally back from December through April, was a $3,100 move if you were trading a micro contract. If you were trading a mini, it was a $31,000 move. So really the point of this slide is to just show you the dramatic difference of being a mini trader versus being a micro trader. Because again, they're 1/10 the size. Some people might think that being a micro trader sounds boring, but the reality is a micro trader might have been able to ride out some of the craziness in December and might have performed better overall. So in other words, a mini trader might have lost 30,000 or more. If they were completely wrong on both moves, they might have lost 60,000. A micro trader at the very worst point might have been down 3,000, and so that person probably had a better chance of staying for the better times and so on and so forth. So anyway, this chart's not meant to predict where the market's going next. It's just showing you the difference between the micro and the mini. And it's not easy to imagine a trader that was, let's say a trader went long in this area, and can't say I'd blame them. I mean, it's a support level. Market's probably a little oversold here. If you went long here with a E-mini and suffered through this, you probably either ran out of money or gave up, right? Not many people would ride that out. Most people would say, okay, I can't take the pain, I'm out. A micro trader may have bought more down here. They may have actually ridden it out, bought more, and look, maybe, I mean, it's hard to say. You never know how you're going to react, or they may have survived, whereas a mini trader wouldn't have. Okay, so why trade micro E-minis? So here are the obstacles that are solved by the micro futures relative to trading the mini futures, which are 10 times the size. There's less margin concern, I should say. So we already said the margin's less than 1,000. It's probably going to be anywhere from $500 to $700 per contract. Generally, it'll fluctuate in that range. But because the margin's so low, you might feel comfortable holding overnight without losing sleep. Remember, the E-mini margin is about $6,600. So let's say you're a small trader let's say you have a $10,000 account and you're in a rough patch or in a little bit of a drawdown. You may not have the margin to hold that E-mini SMP contract overnight. So now that's even more stress, right? Because you have to get out at the close, get back open on the reopen. You may have to pull the plug altogether. So you just don't have the wherewithal to ride a position in a $10,000 account with a mini. But with a micro, you only need $600 to $700 to hold a position overnight. So it's no big deal. You can hold for several days and you're probably not going to lose any sleep. And you're not going to be forced out before the close when you're trading in a smaller account. You'll notice if you've ever seen stock index futures market, at the end of the day, they'll usually trade counter trend. So on an up day, they'll usually sell off a little at the end of the day. On a down day, they usually bounce in the last hour or so of the day. And what you're seeing there is all the day traders that are forced to get out. Because as a day trader, sometimes you may want to hold your position a little longer into the overnight session, but if you don't have the margin to do it, you have no choice. You have to be out. So a lot of those day traders end up covering their positions at the end of the day, and a lot of times they're kind of caught up in the masses of everybody else trying to liquidate, and so they end up getting quite a bit of slippage in their position. As a micro trader, it's no big deal. You don't have to be out by the close, so you can just let it sit if you want to. There's a lot more lasting power. You're less prone to panic, and in my opinion, there's probably no stop loss necessary. Even the worst day in the S&P is probably not going to completely devastate your life, and if it does, you probably shouldn't be trading futures. So let's say the S&P is down 150 points. I haven't really seen it down much more than that, although I have seen it down a little more than that. But 150 points and the S&P would be a loss of $750 in your trading account. No fun. I'm not saying that you're going to enjoy it, but it's a heck of a lot better than $7,500. $750, you probably had a bad day, but you'll live to see what happens tomorrow. If you're losing 7-8 grand, you're probably not going to want to see what happens tomorrow. You're probably done for a while. So you're less prone to panic. You probably don't need a stop loss. You could trade with stop losses, but if you've come to any of our other webinars, it's our opinion, and again, this is opinion, that stop losses are often more harmful than good because positions tend to get stopped out at the worst time. If you're short the market, chances are if you place a stop, you're going to get stopped out at the high of the day and watch the market go without you. That happens all the time, unfortunately. It's Murphy's Law. So with the micros, you're going to see a lot less account volatility. The minis aren't as many as the name implies. When the mini was first created, the S&P was trading at 1,000, I think, or maybe even a little below. So mini was an appropriate name. But now that the S&P is trading at 2,800, 2,900, the value of that contract is a lot bigger. And so what happens is your P&L volatility, the money you make or lose on a 1% or 2% swing, is huge compared to what it was when the mini was originally listed. So the micro is a great way to hit the reset button on that. With the micro futures, you're probably going to mitigate some of the emotional turmoil. Again, it's not nearly as stressful to lose a couple $100 as it is a couple thousand, and so it leads to better trading decisions. I can tell you with 100% certainty, the key to trading is keeping your wits about you and being savvy and just making sound, logical decisions. It's very easy to say, it's very hard to do. And if you're putting yourself in a situation where you're risking too much, you're uncomfortable, you're losing sleep at night, and you're mentally not in a good place, it's not going to go well, trust me. We've all been there. Also, we talked about trading the micros is a great way to kind of paper trade with some skin in the game. So if you want to test new strategies, or if you've never traded futures and you're just looking to get familiar with futures trading, this is a great way to jump in without having too much risk. So you can learn about the nuances of the market. You can see how the leverage works, all those sorts of fun things. A really big advantage to trading the micros is it gives you the ability to speculate with longer time horizons. We all know as a futures trader, when we think of a long-term trade, we think of a couple months. As a stock trader, when they think of long-term trading, they think of a couple years, maybe even a decade. So it's just a whole different mindset, but the micro futures kind of gives futures traders the ability to look at things a little bit different. So instead of saying, I think the S&P is going to go up 10 points in the next couple of days, we can say, well, I don't know what it's going to do in the next couple of days, but I think in the next year or at least the next couple of months, I think the S&P might go up considerably. So you could comfortably put a position on in the futures market and know that, even if your timing isn't right, it's probably, hopefully, not going to be too painful anyway. So let's kind of look at a positional swing trade situation in the micros. A lot of people, when they think of swing trading, they get uncomfortable because you're looking to buy the dips and sell the rips. It doesn't obviously work out exactly how you planned, but that's the goal. You're trying to buy into support and you're trying to sell into resistance. And you're hoping the market really doesn't go anywhere. You're not looking for a breakout, you're looking for the opposite. So Neil's asking, in the micro, do they expire the same months as the E-mini? And yes, everything is basically exactly the same as far as the settlement procedure and the expiration months and all those sorts of things as the mini. So everything's the same except for the point value. And the other difference is the micro does not have options. The mini has options, but the micro does not. The micros are just futures, no options. Again, swing trading is looking to buy the dips and sell the rips. And that can be really uncomfortable if you're not comfortable with the risk of an E-mini S&P futures. Because we all know if support fails or resistance fails, the market could break out pretty sharply and it can be really fast. So with the E-mini S&P, that might be a little too much risk for some people. With the micro, it's just a little more comfortable. I can't think of a better word. It's more comfortable to have the confidence to buy into support and sell into resistance. And another great thing is you can scale in and out of positions incrementally to improve your average entry and exit prices. So if you think the market's going up and you go long a micro, but as it turns out you're wrong and the market drops, instead of panicking or being nervous or hitting the sell button because you just can't handle the pain anymore, you might actually be comfortable enough to say, hey, my mind hasn't changed. I just think this is, maybe I was early, not wrong, and you can add to your position. It used to be that to scale trade was kind of a strategy that was only reserved for larger accounts, people that had really deep pockets, nerves of steel, that sort of thing. The micros brings this strategy to people with maybe smaller or moderately funded accounts, and you can do it relatively reasonably. there's a book out there, I can't remember the exact title, but the premise is if you have unlimited money and unlimited time, you could never lose money trading commodities as a scale trade. If you think a market is very cheap, you go long a future. If it gets cheaper, you buy another one. If it gets cheaper, you buy another one. Eventually, the market's probably going to swing back around and come back. And again, if this isn't something everybody should do, and I'm not recommending this, but I'm saying if you truly did have unlimited money or unlimited time, that would work out basically every time, because commodities don't go to zero, stock indices don't go to zero. Unfortunately, none of us have unlimited time or money, but if we did, that would be the case. We could never lose. That said, you can, even as a medium size or smaller trader, with the micros, you could construct a scale trade that makes a little bit of a sense. I'm not saying you could never lose money, because that's not the case, but you would be able to average your cost, like in your retirement account, say you're consistently buying every month with the money that you're putting in, or whatever it is, every 3 months, however you have it set up. The point of dollar cost averaging is eventually, if the market goes higher, you know, your average entry price is going to be better if you just put than it would be if you put all of the money in at the end of the year. And so it's the same kind of concept with the scale trade in futures. So I already mentioned that these contracts probably aren't suitable for day traders, although the market's been volatile enough in the last couple of weeks that you could probably, you may even want to consider day trading with it if the market's continues to move 20, 30, 40 SMP points a day. I don't think that will continue. It never does. But anyway, it's probably more reasonable for a swing trader or a position trader to use these products. And with that said, a swing trader sometimes is only looking to hold a trade for a couple of days or a day. This particular chart is a 60-minute chart. So each price bar represents 1 hour. So you can see on these areas here where there's resistance and the market's oversold using just the basic RSI. So this isn't any sophisticated system. I'm just kind of using it as an example, not a recommendation for any kind of strategy, but you can see there's definite trend support and resistance lines, and you can see the RSI gets overbought, oversold, overbought. Anytime the market gets a little overheated or a little overdone, it bounces back. If you're trading a full-size E-mini S&P, you may be a little nervous to trade this kind of a strategy, because if it does break, if you notice here, once it broke 2860 support, it fell all the way to 2810 without really much of a leeway. And even if you were pretty quick to get out, you probably lost 20 points. That's $1,000 in an E-mini, so that's quite a bit of money. With a micro trader, you'd be down $100 at this point. So it's true, you're not going to make as much money, obviously, when you're right, but it's just going to be so much more comfortable. You're going to be less prone to panic. With a full-size S&P, or I shouldn't say full-size, that's not the right word, because there actually is a full-size S&P that trades in the pit, but doesn't trade very often anymore. I think it's probably slowly dying. But anyways, with a regular E-mini, a trader in here probably would have gotten completely chopped out. Each one of these moves is 10, 20 handles. So you could have easily lost several $1,000s here, getting in and out, running stops, that sort of thing before the market made a move. With a micro, you probably wouldn't have had all that stress. You wouldn't have been panicking to get in and get out, and your fear of missing out and all that kind of stuff. You probably would have just put it on and you might have survived. So you can see that there's just so much less turmoil going on with a smaller contract that you can reasonably trade a swing strategy, whereas before with the E-mini, you're probably a little too nervous to let it actually play out and work. Just for reference, this chart, I told you it's a 60-minute chart. It spans throughout, I want to say about 2 or 3 weeks. Looks like about 2.5 weeks, so that gives you an idea. So these aren't necessarily day trades, but each one of these moves occurs in about a day or two, day and a half. Unfortunately, the markets aren't always this volatile, so you're not usually going to see that kind of move. But just to give you some reference points also, at the beginning of this range, like if you were skilled enough, and again, this is hypothetical, I'm not saying it's easy to do, but if you were skilled enough to sell the highs and buy the lows on this range, it starts at about $200 to $250 of profit per micro contract. Of course, if you were trading the E-mini S&P, it would be $2,000 to $2,500. But again, if you're dealing with a bigger contract and bigger P&L movements, you're probably going to be a little less likely to hang on for the ride. You're probably going to get panicked out a little more often. Like right here, you may have thought it was a breakout, got flat, and then missed the move. So Micro is just a little easier to keep your strategy in place and your head in place. Down here, once the trading range expands a little bit, it actually gets closer to $400 on per move. And I'm not saying that it would be easy for you to just easily sell and buy and rack up tons of money, because it's not. I'm saying it's more likely you would be able to do so with a micro than a mini. The mini, you have more profit potential, but you're probably going to lose on the little trades. You're probably going to force yourself out of the small with a small loss before the trade ever materializes, if that makes sense. Okay, so somebody's asking if I prefer the micros over out of the money SMP options, the E-mini options. It really depends on, it's not that I prefer them. In some situations, yes. So for the nice thing about the micro is you don't have to worry about premium erosion. So if you want to, let's say that you think the S&P is going up, but you're not willing to take a lot of risk. So you could do two things. You could buy a call option and hope that it goes up enough to cover what you just spent on your option, or you could buy a micro. Obviously, if you buy the call and you're right and your timing's perfect and the market makes an explosive move, you might actually make more money with the call option. But the micro is not going to lose money if the market trades sideways. And if it goes slightly higher, you're going to make a few bucks in the micro, whereas the call option, you would slowly lose money as time decays. So there's definitely some scenarios where the micro might be a better choice than buying a call or buying a put. But it just kind of depends on the situation. All right, so you don't have to use the micros to speculate. You can actually use them to hedge your portfolio risk. And we've talked about this a few times before in some of our webinars, where you could hedge with the E-mini S&P futures, but not everybody has large stock trading accounts that were appropriate for that. So for example, with a traditional S&P future, if you had $140,000 worth of S&P stock, you could hedge your portfolio one by one by selling one E-mini S&P, and that way you kind of put yourself in a scenario where you can make dividends on your portfolio, but you have no price risk or very little price risk. But not everybody has stock accounts in increments of 140,000. So, I mean, you may have less, you may only have 50,000, or maybe you have a couple million, but it's not necessarily in an even increment of 140,000. So if you wanted a true hedge, it would be hard to work with the E-mini S&P. Whereas the micro, you can fine tune it. So if you have a stock account with 160,000, maybe you could sell one E-mini future and then also two micros, and then you could fully hedge your account that way. That said, I would never suggest you fully hedge your stock account, because the one thing we know about the stock market, we don't know what it's going to do today or tomorrow, but we do know in the long run, it generally always goes up. So most of the time, your hedges should be partial, not full, unless we're talking about a market that's running on all cylinders and just seems to be overdone. So for example, maybe if the S&P gets over 3,000, maybe somewhere around 30, maybe a nearly full hedge might be appropriate, but at these levels, it's probably not. So ironically, futures markets were created to provide a venue for hedging price risk. Most of us forget that, because we're here for other reasons. We're here to speculate and to hopefully beat the market. But the futures markets are for hedging. So if you do want to hedge your stock portfolio, this is a great place to look. Just as a simple concept to make sure everyone's on the same page, with a hedge, the idea is you are selling an equal amount of one asset as you're currently long. So if you're long the stock market in your investment account and you sell an equivalent amount in the futures account, you're going to be making on one and losing on the other. But in the end, it's a zero-sum game if your hedge is perfect. There really is no such thing as a perfect hedge, because there's always going to be slippage, there's always going to be calculation issues, rebalancing issues. I mean, it just doesn't exist, but you can get pretty close. In micro terms, if you were long $14,000 worth of S&P stock and you sold one micro E-mini futures from 2,800, if the market goes up, you're making in your stock account, losing on your futures hedge, and vice versa. So there's no price risk or profit potential, but you can make dividend income. And again, I would never recommend that on an average situation. The only time I would ever recommend trying to hedge that aggressively is if the market was really expensive, which some people think it is now. I don't necessarily think it is. I think we've got a little room to move on the upside. But regardless of what our opinion is, the point of hedging is you want to hedge when nobody else thinks you need to, and take off the hedge when everybody thinks you should be putting it on. So that's just kind of the nature of the game. So the great thing about the the micros is it enables investors to hedge their portfolio risk with a scalpel rather than a hatchet. So again, we talked about the smaller contract size. This allows for partial and moderate and efficient hedging, but also because there's micro contracts available on the Dow, the NASDAQ, the Russell, and the SMP, it allows you to hedge different types of stocks. So let's say that you have a portfolio that has blue chip stocks. You could use that. You could use the micro Dow to hedge it. If you have some tech stocks, the FANG stocks, the NASDAQ 100 is comprised of 100 stocks listed on the NASDAQ. Obviously, that's why it's called the NASDAQ 100, but it's really generally almost all moving based on FANG. So if you own a bunch of the FANG stocks, you could use that to hedge. If you have some small caps in your portfolio, you could use the micro Russell 2000. So you can be really efficient in your hedging, and that's an awesome benefit. So let's kind of take a look at just a general example. A stock portfolio worth $200,000 with the following allocation: 40% of it in the S&P, 10% of it in small caps, 30% in blue caps, 20% in tech stocks. And I think that's pretty, generally speaking, a pretty reasonable portfolio. Some of yours might look almost exactly like this. If you wanted a perfect hedge, you could sell 6 micro S&P futures, 3 Russell futures, 4 Dow, 3 micro, and again, you'll still receive the dividends in your stock account, but you have no price risk at all when you consider the balance of both accounts together. And again, I'm going to beat a dead horse. You don't want to ever fully hedge, or at least very rarely. Generally speaking, if you have $80,000 worth of S&P stocks, you may want to hedge 10,000, 20,000. Sometimes you shouldn't have any hedge at all on. When the market's really cheap, like it was in December, I'd say you don't want any hedges. When the market's expensive, you want to start maybe hedging a little bit. So somebody's asking, what are the costs on the E-mini versus, or the micro versus the E-mini? The brokerage costs are the same whether a client trades the E-mini S&P or the micro S&P. So the brokerage costs are the same. So the commission's generally going to stay the same regardless of who you're trading with. The exchange fees are a little bit cheaper, but commission's generally going to be the same. So again, this is not something you want to be scalping or day trading. So in theory, on the micros, your volume shouldn't be that high. It should be relatively low because you're either using it to swing trade or position trade. So commission really shouldn't make a huge difference either way. A buck or two here is not going to change the outcome of your trade. So we kind of already talked about this, but just to make sure you understand. So the stock market goes up most of the time, so you wouldn't want to be fully hedged under most circumstances. Hedge when you can, not when you must. Peel off hedges incrementally as the market falls. One thing that people that do hedge forget to do is take their profits. If you never lock in a gain on your hedge, then it really didn't do you any good. It might have taken off some of the emotional pain that you felt on during a correction, but it really didn't do you any good, right? We looked at that S&P chart earlier. If you had hedged on the September highs in 2018, rode it all the way down, and then rode your hedges all the way back up, you're really not any better off. Obviously, once you take your hedges off and lock a profit on your hedges, if the market goes lower, you have nothing protecting you. But the reality is, let's say the market corrects 20%. If you are able to lock in 10% on your hedge, and the other 10% you just kind of write it out like everybody else does, then you're still better off than you were if you had not hedged, and you probably mentally were in a better state and hopefully didn't panic sell on the lows, which is what a lot of people unfortunately do. So somebody is mentioning that the futures are far more efficient than inverse ETFs, and that's absolutely true. I should have mentioned that earlier. So there are some ETFs that are like reverse ETFs, so that people that think the market's going down, they can actually buy an ETF that's betting on a lower NASDAQ or a lower S&P. Those are extremely inefficient, and they're meant for day trading, so it's the kind of thing you get into it and you should be out by the end of the day, because if you hold on to it for any period of time, you're going to get completely washed out. Even if your directional speculation was correct, you're going to lose money because of the way they rebalance it and that sort of thing at the end of the day. So it's really a no-win situation. The most efficient way to speculate is through the futures markets, from the short side anyway, and from the long side on most commodities. Okay, so just kind of going over, this is obviously the same chart we just looked at, but we're looking at it in a slightly different context. So hedge when you can, not when you think you should. Everybody down here in December they were panicking and they thought, shoot, I either should get out or hedge, and that was the exact wrong thing to do. Everybody up here was probably looking to add on risk or was basically complacent and didn't have any hedge on whatsoever. It's not their fault. It's human nature. We all think like that. We all behave that way, and we're wired that way. But the idea is we want to try to influence ourselves into thinking differently, and it's not easy to do, but it's the right thing to do. So again, if you put on a hedge here and rode it all the way down and then back up, that hedge didn't do you any favors. In fact, it probably just cost you a little bit of money because you have transaction costs and all these other things going on. If you would have taken off your hedge here, you probably would have been pretty sad to see the market go quite a bit lower. But in the end, you're still a lot better off than you would have been riding it all the way back up or not having any hedge at all. Okay, so let's talk about trading delta neutral with options. Well, micros and options, I should say. So if you're not familiar with delta, delta is the rate of change in an option or position relative to a change in futures. A delta of 1 means that the position P&L, how much you make or lose, moves 1 point for every point the futures moves. So if you're trading the E-mini SMP, if your position makes or loses $50 for every point the futures moves, your delta is 1. The only thing that really truly has a delta of 1 is the futures contract itself. A delta of 50 means if the futures market moves 1 point, your position moves half a point. So for this discussion, when we talk about delta, we're going to talk about the delta of an E-mini SMP because we're dealing with E-mini SMP options. But keep in mind, the micro futures, it's 1/10 of a full-size contract, so it has a delta of 0.1 for the purpose of using it to hedge E-mini options. A little confusing. I just told you the futures delta is 1, and then I just told you an E-mini micro delta is 0.1, but that's because we are trading E-mini SMP options, not micro options. So obviously the lower the delta, the lower the position volatility, and the ability to trade options versus micro futures gives you a lot more leeway in regards to taking a directional position without a heck of a lot of risk and the ability to sleep at night. So let me kind of show you what that might look like. Okay, so prior to micro futures being in existence, delta neutral trading required trading multiple E-mini options around an E-mini futures contract. So in other words, because there wasn't any other product available, people that wanted to trade delta neutral generally had to trade multiple lots of either the option or the futures, usually the option. So if they bought or sold one E-mini futures to get delta neutral, they would have to sell 2 or 3 options to get what they were looking for. But now that the micros are in existence, they can trade one single option and then trade 1 or 2 micros against it. And here's kind of an example. So a trader that sells a July, this is a couple of days ago, the market's actually moved quite a bit higher since then, but this is an example. A trader that sells a July 2900 call with a delta of 15 for 11 points, that's $550, could then go long a micro futures near 2770. So this is actually, believe it or not, even though we're selling a call, it's actually a neutral to slightly bullish position because the trader is going to make money on the micro future from 2770 up to 2900. Above 2900, he still has the 11 points in premium that he brought in, plus the profits on the micros to cushion his blow on the upside. So this is a trader that thinks the market's going to go sideways to higher. And as long as the market doesn't continue to collapse below roughly 2660, he makes something. The max profit on this trade would be 1,200, and that would occur if the S&P is at exactly 2,900 at expiration. We know how those things work out. The S&P is never exactly anywhere we want it to be at expiration, but that's the hypothetical. The margin on a trade like this, I didn't run it, I should have, but the margin on something like this would probably be very, very little, $1,000 at the most, probably even less than that. But the reality is this trade, you can see how this trade is constructed. The only way to lose money is if the S&P is below 2660 at expiration. Probably not an extremely likely scenario, but it is possible. Actually, I shouldn't say the only way. If the market explodes higher, well above the 2,900 strike price, then there is some risk on the upside. The risk we figured would be about 29.24. So as long as the market stays between 29.24 and 26.60, the trader makes something, maybe as much as $1,200. So it's not too bad. And this is, again, this is kind of delta neutral trading with premium collections. So you have the ability to make money on the long micro futures. You have the ability to make money on time value erosion. So in conclusion, the micro E-mini futures could be a good place to look for those who are looking for a way to speculate efficiently with lower risk, less stress, and better odds of success. Also, those looking to hedge a portfolio risk or to manage risk and or avoid a taxable event, the E-mini micro futures product suite makes sense. And I should have also mentioned on here, if you're an option trader looking to hedge your short option risk in the SMP, this is also something to consider. At our brokerage, we do have quite a few traders that like to sell SMP puts, which is one of those strategies that works almost always, but when it doesn't work, it can get pretty painful. This is one way that might be something to counteract that. So if the S&P starts getting volatile and the options start getting expensive, maybe selling a micro or two just to kind of take off some of the downside pain might be something that would make sense. And every situation is different, but something to consider. So I appreciate everybody coming out. I hope you got something from it. If you have any questions, feel free to contact us. We appreciate your support. And again, we have a buy one, get one deal going on. If you didn't receive an email on it, send us an email. I'll send you a link. And if you have any questions, here's my information. You can feel free to send me an email or give me a call.